Over this past weekend, Warren Buffett released his 2021 annual letter to his shareholders. And in this video, I want to cover my key takeaways from that letter. So let's jump right into it. I think Warren Buffett's annual letters are required reading for every investor out there, even if value investing isn't exactly your style, because there's probably an MBA's worth of information packed into these letters, and compilations of these letters are some of the most valuable texts, I think, out there on investing. Another reason why I really enjoy reviewing these letters every year is that they provide a great opportunity for us to revisit the basics, because Buffett does repeat a lot of the same things. But that just harkens back to the idea that his approach to investing is simple, but it's not easy. So understanding the fundamentals, the basics that he's been harping on for his entire career are extremely important to keep ingrained in your mind. We want to learn from the master, so of course it's a no-brainer to go over these letters every year. Okay, first off, we can take a look at, as Buffett always reviews every year, his performance against the S&P 500. So, of course, he has trounced the S&P over his lifetime as CEO of Berkshire, which is 57 or 58 years, I think. So last year, Buffett was able to beat the S&P by about 1%, which isn't world-beating returns or anything, and certainly doesn't compare to the early years of his tenure with Berkshire, but 1% gains is nothing to sneeze at. I'm sure shareholders will accept it. And as Buffett talks about a little bit later, Berkshire may not be the best investment for shareholders simply based on returns, but there are a lot of other factors that go into why someone might want to hold Berkshire shares. Okay, so we'll move on to the opening of the letter. I took some notes throughout as I was reading this. Here, even the first line stood out to me. I underlined, he and Charlie have the job of managing a portion of your savings, and we are honored by your trust. And this is kind of a tangential idea, but this is a thought I had where this is a reminder that we want to behave like Warren and Charlie, or I do. I want to behave like Warren and Charlie as I'm thinking about managing my portfolio. I am in a very privileged position to be able to spend and dedicate some time managing my own money. And so I'm going to try to behave in a way that I deserve to be in this position. It's been an honor and a privilege to continue to learn from Warren Buffett and Charlie. So I want to have that reflected in the way that I manage my portfolio. One interesting note is that Buffett didn't really find many new investment opportunities except for one, and he discusses it at length later in the letter, but that is share repurchases of Berkshire Hathaway itself. Now, I underline this because he says the task has been my primary duty for 57 years, and it will continue to be. And the primary focus is to increase the intrinsic value per share of Berkshire Hathaway. And one thing that this reminded me of is how Buffett, throughout his whole life, every account of his life, he's been singularly focused on this one goal. And boy, has he succeeded at it, obviously being one of the richest men alive in all of history. Speaks for itself. Both Warren Buffett and Bill Gates have attributed most of their success to their single-minded focus on the task at hand. And in Buffett's case, that's compounding the intrinsic value per share of Berkshire Hathaway. And before that, it was compounding the value of the partnership stakes for his limited partners in his own fund. So keeping in mind, what are my goals for achieving the returns that I think are acceptable for my portfolio, and what are the actions that I need to take to get there? Okay, moving on. This is an idea that Buffett has made famous and repeats very often. His main goal is to invest in businesses with both durable economic advantages with first-class CEOs. So those are two of his core investing tenets, and he repeats them repeatedly. He probably doesn't need reminded anymore, but I think everybody else who would benefit from hearing these things on repeat every day. And again, just repeating the investment philosophy, we own stocks based upon their long-term business performance. He and Charlie are business pickers, not stock pickers. I think that's one of the huge takeaways. And it seems simple, it seems obvious, but it's worth repeating because of how important it is to think like an owner of a business that you're investing in. Down here, I've highlighted business pickers, business investors, and business owners. These are all terms that I think going forward, I'm going to try to use to describe myself instead of just an investor, or I definitely try to avoid the phrase stock picker or looking at stocks, because what I'm trying to do is understand a company and buy that company if I think it's selling for less than it's actually worth. Rob Vinall, for instance, follows this to a T. He calls his fund the Business Owners Fund, which I really admire. I think that keeps that idea top of mind. Every time he thinks of his fund, he's going to think of himself as an owner of the businesses that he partially owns. Buffett also notes that he is human and he makes plenty of mistakes. And the good thing about investing in equities or common stocks of companies is that it's rather easy to get out of a situation that you deem as a mistake. And sometimes you can even get out of a mistake at a slight profit. Contrast that with wholly owned businesses, which Berkshire specializes in. They buy businesses, and sometimes those don't turn out to be as economically viable as he might have thought. Or real estate deals or venture capital firms where there's a bit more tie-up, a bit more legwork, and actual logistics to take care of to get out of a bad situation there. That's definitely one of the benefits of investing in public companies that I really appreciate. All right, so then on the next page, he goes into discussing some of the specifics about Berkshire Hathaway. In this case, last year he talked about this idea that Berkshire owns a huge swath of the infrastructure assets in the United States, and they own more than any other American corporation. So anything that would fall under the property, plant, and equipment line on the balance sheet would fall under this category. In total, he says there's almost $160 billion worth of these infrastructure assets. So you can think of all of the energy investments, all of the railroads, things like that. Berkshire has a huge footprint in the United States. Then he goes on to talk about taxes. I don't know if Berkshire has been getting some flack about not paying taxes. I know Buffett is a proponent of increasing taxes, but also at the same time, he's not going to pay more taxes than he's legally obligated to. Why would he? But he goes on to discuss how much money Berkshire's actually paying in taxes. He goes through a history of the early days at Berkshire Hathaway, where as the two companies merged to become what the company that Buffett took over as Berkshire Hathaway, there was a lot of capital destruction because of dividends that should not or did not deserve to be paid, share repurchases at prices that were greater than the intrinsic value of the company, and just the secular decline of the textile industry in the United States at the time. It's just kind of a funny story that back in those days, in the early 60s, late 50s, Berkshire was paying about $100 per day in taxes, and today, Berkshire pays about $9 million daily to the government. I think that's pretty crazy. Berkshire definitely contributes to the tax base here. And Buffett moves on to discuss the insurance float that his company has generated since the beginning. Let's see, he starts out talking about how he purchased National Indemnity in 1967. And at that time, they had $19 million in insurance float, and that has ballooned to $147 billion today. Insurance float is a key part of Berkshire's investment strategy because it provides them with a lot of cash that they can deploy for the long term that doesn't actually belong to them, but is still investable anyway. Float includes the money that policyholders will pay to the insurance companies of Berkshire for potential coverage in the future. And Berkshire can in turn take that money and invest it somewhere else. He calls float very sticky, and he says that while the funds go in and out daily, they fluctuate, there is a very little chance that it's going to decline precipitously. So that's almost a permanent source of capital for Berkshire, and that goes a long way to helping them be able to make acquisitions or investments in publicly traded securities. So the insurance business is really important to Berkshire. And I think at one point in the letter, he describes it as irreplicable by any other company. So they basically have this endurable moat with their insurance business and the float that it provides. So that's not something that we'll likely see again in any other American corporation. Next, Buffett moves on to what he categorizes as his four giants, which are basically the big cash cows for Berkshire Hathaway. The first one is, again, the insurance business, which provides all of this insurance float that they can reinvest into other opportunities. But yeah, here's the part where he discusses about Replication of Berkshire's operation, however, would be almost impossible. So they kind of have something very unique. All right, next up, which is not surprising at all, is the investment in Apple. Now, this is Buffett's best investment on a net cash basis by a long shot. And he touched on the topic of share buybacks for Apple last year as well. But again, he says that their ownership went up from 5.39% up to 5.55% in Apple without doing anything. They didn't change their investments. They didn't buy more. Apple simply has been enacting their share buyback program, which gives each current shareholder a larger ownership stake of the company and therefore the company's earnings. So just imagine that Berkshire Hathaway owns 5.5% of the largest company in the world. It's just mind-blowing. So a few more notes on the Apple investment. As far as dividends, Apple pays $785 million to Berkshire Hathaway every year. And more importantly, Berkshire's share of Apple's earnings is $5.6 billion. The next giant is the BNSF Railroad that they purchased. He calls it the number one artery of American commerce and an indispensable asset for America as well as Berkshire. BNSF accounted for $6 billion last year in earnings, and he takes a special note to point out that these are the real net earnings for BNSF. That's not any adjusted number like EBITDA. Charlie Munger is famous for calling that BS earnings, and Warren Buffett kind of alludes to that in a more friendly way. I would say that bull markets breed bloviated bull ... Deceptive adjustments to earnings, to use a polite description, have become both more frequent and more fanciful as stocks have risen. So yeah, one of Buffett's core tenets is he wants to see real earnings and real cash flow, but ignoring very real expenses like interest, depreciation, amortization, taxes, is a little bit foolish when trying to actually get at the value or the real earnings power of something. And then finally, there's Berkshire Hathaway Energy, which has increased 30-fold since Berkshire initially invested in the company in 2000. So their earnings are about $4 billion for the past year. So again, this is a part of Berkshire's huge ownership of hard industrial assets in the United States, a bunch of their energy initiative projects. And I like that he points out that Berkshire Hathaway Energy has been faithfully detailing its plans and performance in renewables and transmissions every year since 2007. I know there's been some pushback from shareholders about the green energy movement and whatnot, and there was even a question a few years back at the annual shareholder meeting. But Buffett is being as clear as possible that BHE is very transparent with this information. All right, moving on to the investment portfolio for Berkshire Hathaway. He provided some pretty interesting color this time. Something that I wasn't aware of is that Todd Combs and Ted Weschler, they manage about $34 billion of the massive portfolio as a whole. Those are huge sums. Most of those are bigger than a lot of the portfolios that some of the super investors that I follow on websites like Dataroma invest. Some guys are, sub 500 million that I admire. So that gives one way to think about things is that Todd and Ted are in a completely different universe than even most of the super investors that I follow. While their investment ideas probably make a lot of sense for them, for smaller investors, they may or may not be the best place to look if you're looking to clone these guys. One really interesting thing, though, is that there is a large portion, it's not explicitly stated here, of the money that Todd and Ted manage is actually in various pension plans for Berkshire-owned subsidiaries. So my note on this was that they're extremely incentivized not to lose money because that is retirement money that their employees and their coworkers are relying on for the future. So just as Warren and Charlie are responsible for shareholders' savings that they've invested into Berkshire Hathaway stock, Ted and Todd are responsible for the preservation of the wealth that's being put into these pension funds. So I think it really emphasizes the rule number one for Warren Buffett, which is to not lose money. And there's basically structure at Berkshire Hathaway to ensure that that remains rule number one. But anyway, I highlighted a bunch of these percent owns of companies. Look at this. This is crazy. Berkshire owns 20% of American Express, 5.5% of Apple, 13% of Bank of America, 8% of Bank of New York Mellon, 9% of Coca-Cola, 13% of Moody's, and almost 10% of US Bancorp, along with all of these other listed companies he's owned. He owns almost 8% of BYD, which is listed in China, which is not frequently reported, so the transparency here is nice. So the sheer size of Berkshire, it always astounds me, and they're going to continue to accumulate even larger portions of many of America's greatest companies. He touches on their cash balance, which has ballooned to $144 billion. A lot of that is in U.S. Treasury bills, and the sheer amount of money that they have in Treasury bills, Berkshire says, Buffett says that he's financing one half of 1% of the publicly held national debt. So you can thank Berkshire for helping to fund the debt problem. And then another one of their tenets, which I wasn't familiar with this, they always will hold at least $30 billion of cash or cash equivalents, because they don't want to be dependent, as he calls it, on the kindness of strangers. They don't want to have any rugs pulled out from under them and then they can't handle it. Maybe there's a huge insurance claim that they'll need to pay for or anything. $30 billion theoretically should cover them in any scenario that they might find themselves. So this goes into another idea that Buffett touches on, which is what I would call portfolio management, not a tip, but the way Buffett's brain works and the way that Munger's brain works when thinking about holding cash in a portfolio. Buffett says that after his initial purchase into the stock market, he's never been below 80% of his net worth invested in equities. And his preferable state is to have 100% of his net worth invested. There's a lot of debate on the merits of holding some cash for a potential opportunity that might arise versus being fully invested. Now, right now, personally, I'm in the camp of being as fully invested as possible because I have an income that I can use to continually add to my portfolio. And Charlie also mentioned this at the Daily Journal company I noted. He said that he's never really waited around with a huge cash pile to wait for some investment opportunity. He always just tries to make the best of the current market situation at the time, and pretty much remain fully invested if you can. I'm pretty clearly in their camp personally, but there are definitely merits to holding cash, and it doesn't work for everybody to always be fully invested. And Buffett moves on to discuss the share repurchases for Berkshire, which was the major source of the increase in intrinsic value per share for Berkshire. And I noted, remember the basics at the top of this. There are 3 ways that we can increase the value of your investment, according to Buffett. Number 1 is by increasing the long-term earnings power of the businesses that are owned wholly by Berkshire Hathaway through reinvestment. Number 2 is you can buy shares in publicly traded companies that are wonderful businesses like Coca-Cola, Apple, or something else that we haven't seen yet. And number 3, of course, is to buy back shares. But of course, share buybacks don't always make sense. Buffett is sure to point that out down here earlier or later in the letter, that it's actually a value destroying activity if management buys back shares when they are above intrinsic value, because you're buying something for more than it's worth, which is the exact opposite of what we're trying to do when we're investing. Is we're trying to find something, find the value of something, and then pay a lot less. So over the past 2 years, Buffett has bought back almost $52 billion worth of shares, which equates to about 10% of all the Berkshire shares outstanding at the time of 2019. So with these share buybacks, if you're a shareholder of Berkshire Hathaway, not only does that increase your share and your rights to the earnings of Berkshire Hathaway's businesses, but it also increases your share of the earnings, the look-through earnings for all the portfolio companies such as Apple, Moody's, all the listed companies that they own. I want to scoot back up here. He briefly talks about interest rates and their effects of interest rates on investment opportunities and assets. So generally, when long-term interest rates are low, that really inflates the price of assets, equities, commodities, things like that. So Buffett has described the effects of interest rates on prices like gravity. The higher the gravity is, the lower the price of something, basically. So when thinking about current opportunities in the market, I'm thinking, I know I can't predict where interest rates are going to go, but it's an important variable to consider what happens if interest rates do continue to rise. And it's particularly important if you're discounting the future cash flows of the business that they're going to generate back to the present. It's just a reminder to use a very conservative interest rate, because we don't know where they're going to fluctuate. But if you build in a large enough margin of safety when you're thinking about those discounted cash flows, then likely the results will be better. Buffett rounds up the letter with a story about one of the late CEOs of a Berkshire company named Paul Andrews, who decided to sell to Berkshire after deciding that that was probably the best option for something that he'd been working on for 35 years. He didn't want to sell it to somebody for them to have a bunch of layoffs within the company. And actually, through knowing Paul Andrews, Buffett was able to set up a meeting with the CEO of BNSF at the time, and that eventually led to a relationship where Berkshire became the majority owner of BNSF. So I noted that there is a serendipity of Buffett creating his public persona and curating his reputation to attract the type of opportunities and businesses that he owns. So basically, he's acting in a way in which he deserves to own these extremely high quality businesses, which, to kind of wrap it up and bring it back to the beginning of what I was talking about at this video, I want to manage my portfolio in that same way and build a reputation that is, worthy of being in a position that I'm lucky enough to be in right now. Oh, and one more quick mental model is called the orangutan effect, which I thought was really funny. Charlie has coined this term, obviously, colorfully, that you should, it's another notion of really understanding what you're talking about. And it's just like writing or teaching something. You should be able to sit down and talk to an orangutan and explain whatever topic you're talking about. And while the orangutan may not understand anything or may not have come out any wiser, the teacher, you, definitely will have come out with clearer thinking. In software development, that's sometimes called the rubber duck method, but I like the orangutan effect too, where you basically just talk to something, and as you talk about it, you begin to understand what your misunderstandings, your shortcomings are, and that's the first step in trying to solve a problem. One final note, there's this concept called satisficing, where you find you might buy something and it's not the best of the best, it's not the worst of the worst, but it satisfies exactly what you need without investing too much time into figuring out how you can optimize that specific item. So for Berkshire, it's a balance of being in a comfortable position with your investment, trusting the management, trusting the safety of your money over maybe the most optimal allocation for the best returns. For the rest of Berkshire's life, Berkshire, they might slightly beat the S&P. They might beat it handily. They could possibly perform worse than the S&P, as if we saw last year. They performed way worse than the S&P. But over the long term, it's pretty clear that investing in Berkshire is a good way to at least preserve your money and probably match the market, but with a bunch of people that you like, admire, and trust. So I think that's a good place to end this. Those are my key takeaways from Warren Buffett's shareholder letter this year. Even if there wasn't a ton of new information, I still hope that it was valuable to review these basic concepts of investing, because at the end of the day, these don't go out of style. They're kind of the fundamental ideas of investing, and keeping those in the top of mind go a long way for me personally to continue to invest the way that I want to. It's a sanity check, it's a rationality check, so every year I look forward to this reading of his new letters. If you enjoyed this video, you may enjoy my series where I'm covering Nick Sleep's annual letter to his partners. Thank you so much for watching this all the way to the end. I really appreciate your time. If you enjoyed this video, please like the video and subscribe for more, and I will see you in the next one.